Yep, I'm Terry Smith, and I want to talk about the Fundsmith Equity Fund and about how I think fund management should be done, as opposed to how it is mostly done. It's a company that was founded by me. I have to put up a disclaimer first, otherwise the regulators would worry about us marketing to you without putting up something which basically says, if you believe what I say, it's your problem, which I believe is what that legalese probably says, if you would care to read it. It's a new type of fund management company with a different type of fund, which I'll go on to describe to you. And it's basically a way to co-invest with me, if that's of any interest to you. I put £25 million of my own money into the Fundsmith Equity Fund on day one. And as the little quote on the side there in the grey box says, as you can see, the greatest testimonial is to eat your own cooking. Someone once said, you should never trust a thin chef, basically. And I do eat my own cooking. The genesis of this is actually a company called Tullett Prebon, which I'm the chief executive of. It's the second largest interdealer broker in the world, and I bought control of it in 2003. It's still quoted on the London Stock Exchange with a market capitalisation of about £900 million. When we bought it, it had a big deficit on the pension fund, and we knew about that. It wasn't a surprise. We obviously found the deficit in the course of due diligence. And so we decided that we had to do something about that, and we took a completely different route to what most people take regard to management of their pension fund. Basically, what I persuaded the trustees to do was to fire the actuary, the investment advisor and the fund managers, and to appoint me as investment advisor for that fund, and set out on a completely new strategy. And the strategy involved basically going into a long-only strategy and buying just 20 global companies with a buy and hold intention, that we would try and hold on to them as long as possible. That's what's happened to the scheme. Those are taken from the Tullett Prebon accounts. You can see 2004, which is the year after I bought control of Tullett Prebon. We had a triennial valuation done by the actuaries, and you can see there we had 75 million of assets, 114 million of liabilities, and a £38 million deficit as a result. We just had another triennial valuation in 2010, 6 years later, and you can see the scheme assets have risen to 170 million. The liabilities have gone up as well, because clearly the liabilities rise each year with increases in pay and inflation affecting the underlying liabilities to the pensioners. And you can see we are now in surplus, £24 million. That was basically based upon the investment performance of the fund, and that investment performance is here. You can see in those two tables, I've compared our investment performance, which are the bold figures towards the bottom, with the performance of a number of benchmarks: the MSCI EFA Index, the MSCI World Index, the FTSE 100, the short bond and the long bond. And you can see, if you take what I think is the nearest comparable index, which is the MSCI, we basically have compounded at about twice the rate of the MSCI during that period. We've gone up at about 14% per annum. The MSCI went up at about 7% per annum. But the really startling statistic, I think, if you look at that slide, is the turnover on the fund. If you look at the very bottom box, you'll see that the average annual turnover on the fund is 4% per annum. Now, if you've got 20 stocks, 20 into 100 is 5, which suggests that if we just change one stock per annum, we'd have 5% turnover. We clearly have changed less than one stock per annum during this period. And on 4 years, the turnover wasn't voluntary. It was caused by a takeover in which we lost one of the stocks in the portfolio and had to find a replacement. So it's been a very, very low turnover strategy. It's exactly the opposite of what most investors and fund managers do in that regard.